What's up, guys? It's Trevor, and I am so excited today to show you how I go about analyzing properties. Now, this is specifically for a property that you want to be an investment property. Maybe it's a duplex or something like that. Let me show you what I do, and I'm sure a lot of people have their own method, and you can add your own kind of flair to it. But check this out. Here's the last property we bought. I have a nerdy little spreadsheet right here that if you asked me for it, I would totally give it to you. And here's what I want to do. I want to go through what they call the pro forma. I'm going to plug in some numbers. I'm going to show you kind of how they give me an idea of whether or not this is going to be a good investment. Okay. So let's say this property was that we bought it at a fair market value of $440. All right, I'm going to start plugging in some numbers, okay? I don't need a discount right now. Let's say we put 20% down. I don't exactly remember. And interest rate, that's about right for what I paid. Interest rates are lower, by the way, for owner-occupied. If you're doing an investment, they're going to be higher. Okay, and then we're going to plug in some monthly rent here. Let's assume the same on the other side, although it's not there yet. And the cool thing about this form is it's going to give you some ability to put some fees in there. So you can kind of do a little bit of a profit plus a little bit of expense. Let's just assume, yeah, these are good. We'll just assume this. Maybe $30 in utilities per month. I like to always just kind of be a little conservative. If you're concerned, then underestimate the income and overestimate the expenses, and you're going to come out with a conservative estimate. Okay, that's looking pretty good. And so this income, which we have a duplex here, so we have two sides of income every month for a net rental income of $41,000 per year, and we have expenses of $37,000 per year, right? So that's going to give us a net cash flow of $9,200. Now, that's also including a maintenance reserve. So we want to save a couple thousand per year for things like a roof and siding, just whatever's going to go into the property. We're going to have to pay taxes and insurance on the property. So I'm estimating for that. And then we just have miscellaneous leasing costs, right? It costs me some money to do business. Now, if I wanted to put anything else in here just to be extra conservative, I could. However, I'm just going to leave that. Now, what assumptions are we making on the property? Let's go back down. I'm assuming that the property is going to grow, appreciate. The value of the property is going to appreciate at 5% per year. It's less than what we've seen last couple of years. Last 10 years, we've probably seen 7-8%. Maybe not for 10 years, but last 5 or 6 years for sure. Rent appreciation. Rents go up. Guys, if you're renting right now, I want you to buy a house because this is going to happen to you. Rents are going to keep going up. And then there's costs associated with selling the property. So why are these here? Well, because I'm going to flip to the next thing, and it's going to show you a breakdown of my entire analysis. So when I go over here, it's going to give me year 1 through 30, okay, because we're assuming a 30-year loan. 1 through 30, here's going to give me all kind of my numbers, right? So here's the income that I'm going to make, and then 5% more next year is going to be this, and so on. So we see the growth, the 5% growth, okay? Oh, by the way, vacancy means that 5% of the year it's just vacant. It's not going to have renters in it. There's turnover. There's time between people that have moved in, things like that, okay? So here's my annual net cash flow. This is only making me $9,200 in positive cash flow the first year, $11,000, and then so on. Look, by the time we get to year 30, we should be looking at a cash flow positive situation of $132,000, okay? $132,000 per year, okay? That's awesome. Now let's take a look over here at equity. You can look through all these if you want. If you want this spreadsheet, if you're nerdy like me, let me know, and I will give it to you. So equity, 113 because we put some money down. It's got some equity in it, whatever. And I'm assuming that 440 was market value. I think market value might have been a little bit higher. We were in this weird bubble where interest rates have gone up. But by the end, 1.9. If you ask why I want you to get into real estate investing, this is why. 1.9. Okay, that's your overall equity at the end of 30 years. What is my total cash in? So you'll see that I put some money into the property. I had I put a down payment. Let's say I put the down payment in there. It also gives me room to put like costs to make ready. I think I actually did put a little bit cost to make ready here, but not a ton. So you can calculate all this and you can say, okay, what's the, oops, that comes later. What is the total amount of money I put in there? And it's going to be $88,000. That's it. That's your total cost to get going, right? And I'm not turning my nose up at that, but that amount's not going to keep going and going and going, because every month that the tenants pay the rent, that money goes out and pays the mortgage, right? So what is my cash on cash return? That means what's the return on this $88,000 as a percentage? Well, the first year it's 11%, not bad. But then it just keeps going up. Why does it keep going up? Because this amount doesn't change. So every year, my cash on cash return looks better and better. Okay, now we're gonna go to our final nerd column here, which is the accumulated total return. And that means debt pay down, cash flow, appreciation, everything that you're seeing a return on is right here. The first year, not bad, but not great, right? This includes all the cash flow you get, the appreciation, the amount of debt that you paid off on the property, and so on. Look, by the end of this, we're at $3.5 million for a property that was like, okay, but it's not like the most amazing thing in the world. I am a buy and hold investor. That means I don't flip these. I buy them and then they get paid off over the course of 30 years, hopefully sooner. And so I'm looking for that return in the long run. Okay. So 3.531. Okay. So great. Let's go over here to, I just want to, like, for fun, compare this investment, which admittedly is overly simplified, right? So this, by the way, this is not showing me depreciation tax benefits on the house. It's not showing me the interest tax benefits. I have a different spreadsheet that an ultra nerd gave me that shows all that as well. And I could show you, based on tax bracket and everything else, how real estate helps you, but I'm not a tax advisor. You probably want to talk to a tax advisor for this. But let's go and let's say we took that 88,000. Let's say we took that 88,000 and we didn't add anything to it, right? We just let it compound over the course of 30 years. I'm gonna do that over the course of 30 years with an interest rate. I don't know what's the market at, like 9. You know, the S&P 500 is probably 9 or maybe 10%, something like that. And I don't know, plus or minus a couple percentage, right? When I calculate that, in 30 years, this investment's going to be at 1.5 million instead of what I say, total investments 3.5 million, something like that. Hey, what's up? It's Future Trev here. I had to interrupt and interject on my own self here because I realize a lot of you are probably screaming at the thing right now saying, yeah, but you're compounding this annually. Okay, fine. So let's compound this monthly and go from there. Granted, it's going to be a way different story when you compound monthly. It's at 1.745. Okay, so if you're screaming at your phone or whatever, there you go. Let's compound it daily. What the heck? I think that's how the market works. 1.7. Nothing to turn my nose at. Again. Now, if you compounded this, infinitely, it would be even more. But you're probably not going to make it to 3.5. Okay. All right. Future Trevor out. So you can see why people really win in real estate. But here's the downside. Before it just looks awesome on paper, keep in mind that when you invest in the stock market, you just set it and forget it. You don't have to worry about it. In real estate, you got to figure out how to go change a toilet. You got to figure out how to. The HVAC's not working, so you got to flip a switch. Somebody locked themselves out of the property. There's a reason why real estate pays more as far as an internal rate of return, and that is because it's just more work. It's more work than like the stock market. And I'm not saying this is for everybody, but if this looks interesting to you, and if you want to compare whatever you're putting in to the market to like what that could look like in real estate, talk to me because I love helping people buy and sell real estate. Okay. Now, I'm not going to tell you to cash out your 401k. That's one thing I'm never going to do. I'm not even going to say don't be in the market. You're going to have to get with your financial advisor on that. What I'm saying is that some people have a propensity to invest, and they like to drive by and see the house. They like to have the monthly rent coming back to them. They like to see the property that they actually own instead of being in the market and theoretically owning some piece of that, which again, I do that too. But let me know what you guys think. Thank you for watching. And if I can help you out at all, I want to, because I love real estate and I hope you do too.